Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And the theme tonight is the stocks that look good for 2023. We kick off with Jun Bei Liu of Tribeca Investment Partners. And she actually featured on an unusual company when she presented at the Son's Hearts and Minds conference in Hobart only a couple of weeks ago, which attracted a lot of newspaper attention. She went for a company called China Tourism Group Duty Free Corporation. She also likes a number of other companies like Domino and Tyro, and she also looks at lithium mining. But that China Tourism Group Duty Free Corporation is an interesting story, and she fills you in on how you can invest in it. Then Michael Wayne of Medallion Financial looks at the company he likes. In particular, I get him to focus on Ordinate, which has done very well despite the fact that tech stocks have been sold off, and Megaport, which has been up and down but tends to be liked by the experts. So it might take a year or so for it to come good, but the analysts really like it. He also is very interested in Xero. So is Jun Bei Liu. And also Paul Rickard looks at the three stocks he really likes, CSL, Macquarie and Xero, and a special high-tech one, but you're going to have to read the Switzer report to get that one as well. That's the show. Let's kick off now with Jun Bei Liu of Tribeca. Thanks for joining us, Jun Bei.
Thank you for having me.
Now, we should talk about your big story at the Son Hearts and Minds conference. And you came up with a company you never ever talk about here, but can Australians easily invest in that company?
Look, absolutely. It is a company, it's called the
Tell us about it.
Yeah, absolutely. It's called China Tourism Duty Free. Essentially represented the entire duty free sector in China. It's 90% market share. It's listed in Hong Kong, and it is, it's incredible business. It's essentially has been growing with the China duty free market. And in the last many years, you know how many Chinese travelers are there. In the next couple of years, they will reach 7.5 billion trips they make within China.
And they're locked down now, but are you thinking once lockdown eventually is over, there'll be like a tsunami of Chinese travellers?
Not only that, so even within the current lockdown, this company still made $1 billion. Yeah. How did they make that? They're the largest duty-free company in the world. So they actually get really good deals out of airports, really good deals out of all these brand owners and things, and they sold online. They get all these special deals sold online.
So rather than having to fly somewhere, they've actually...
People are buying it online because of the lockdown. Now, once that opens...
Before then, they didn't do it?
Before they didn't do it, now they could do it.
So business,
and going forward, once they open, they will still have the online channel. And also, there's another policy change. In China, most of the company had the regulatory things going against them. Yeah. But this one actually been going for them in the last few years. So Chinese people spend 40% of global GDP spend, in a normal year. Now, but the thing is, they spend most of that in Korea, Hong Kong, and a few other places. Why is that? They can't buy it in China because in China it's still very expensive and there's a cap. Every person can only spend $5,000 US. That's way too low, right, to buy those blings, right? So what China has done in the last few years, they said, look, we're going to repatriate, bring those dollars back because all these Chinese tourists are going overseas to buy them because it's 40% discount when you buy overseas. China, too many taxes. So they said they create this little island, which is known as Hawaii of China, as the Hawaii of China, full of people, of course, on the beach. Easy to get to for Chinese people, and there's no visa required. And they made that zone special duty-free zone. So things, luxury goods in that area, in that city, is almost 40% cheaper. Same price as people travel to Korea. So in the last 2 years, duty-free spend in that zone used to be, so in 2020, it was $1.8 billion US dollars. Now, this year, it's 8.5 billion US dollars.
That's a big increase.
And this is a tiny city. And in another 5 years, it's going to get to $40 billion. This company has 90% market share. So not only globally duty-free spending, they're actually capturing where Chinese...
But could Xi Jinping get in the way and hurt this business?
So this business is actually part of, it's a partly state-owned business. Okay. So it represents essentially a Chinese duty-free company. No, it's a Chinese duty-free company. So its purpose is really trying to bring the tourism dollar back into spending within China. And this company has $3 billion US dollars on the balance sheet.
And I guess it's not a totally new model because the Japanese tourism often would do that, wouldn't they? they would fly Japanese airlines, they'd be on JTB buses, and they go to duty-free places that ran with Japanese businesses. So it's not something that's totally new.
Look, they just copied what's been happening, but just bigger scale. And now they got $3
Bigger
billion.
scale.
They're going to Europe. They're opening up more shops globally now, following wherever the Chinese tourist is going to go.
Yeah.
And they're going to buy luxury brands.
All right, what is the share price up by? Because have we missed the boat, or is this going to be a fast boat to China?
Oh, no, not at all. So it's going to be a fast boat. But right now, China still has yet to reopen the economy. Business like that, Chinese tourism companies has really been in that sort of start-stop stage, haven't really moved. So ticker code 1880 has yet to move.
1880.
1880. It's
Why?
a good luck.
Is it really?
Yeah, it's a lucky number.
It's not a significant historical date in Chinese history?
Not really. But maybe.
But eights are good numbers for Chinese people.
8 is it means lucky, it means actually get rich. Chinese are very big on the money monetary side.
I've never noticed that.
Yeah, not at all.
Okay, that was an interesting company. Locally, are you seeing any value at the moment?
Locally, actually seeing a lot of value in the local businesses. Particularly, look, we talk about the growth and growth. There's just a lot of them being left behind. A couple of them started to work, things like Domino. Remember we talked about Domino?
You talked about Domino about 2 or 3, well, maybe a couple of months ago.
Yeah, and then remember we said there's one more downgrade that came. And then the downgrade came, share price went down, but it rallied really quickly. So, you don't buy Domino for next week's earning. You buy it for, 5 years, and things are going pretty well for them.
But what makes you think that people are going to eat more pizzas?
It's not about eating more pizza. It's just within existing territory, it is what it is. But what Domino has done is that globally they're rolling out more territories as well. So in Australia, it's pretty mature. We just eat this many pizzas. That's about it. In Europe, they're just ramping up the pace. Yes, economic slowdown maybe will slow it somewhat, but it's about opening more stores. They just reach scale. So you're really the margin expansions from there on. And now they got Taiwan, which is brand new, and Japan is doing okay. So it's the global expansion that is going to drive the future.
Is the CEO still the same?
Yeah.
Don May?
Yeah.
Okay.
I like him. He's done well. Yeah.
He's a good CEO. All right, so that's Domino's. What else do you like?
I think at this point, we're just looking through. A lot of them have had a good rally, but we started looking back at some of the old favorite like CSL. Still looks pretty good. It's almost $300, but it's still relative to some of the other things. Still look pretty good.
You give me a 1-year profile on CSL.
It'll be higher.
I wouldn't be surprised to get 330, 340
absolutely.
Easily.
Absolutely, and it's defensive. Even if we have an economic slowdown, even we have US recession or global recession, it's not going to slow down. It will grow double digit for the next 3 years, and it's regardless of what happens to economic condition. So this company is very, very defensive. And a few other companies, look, we talked to previously, talked to things like Xero, have yet to move, had their result recently, and I think investors just a little bit worried about economic slowdown things. This company just put through some massive price increases, and then they've done
lost no customers.
Yeah, although the customers are still there, right? So things are still going pretty well. So and then this is a penetration story. Like it's a market expansion, and then the UK is still going very well. So
what about Tyro? Tyro's chairman resigned last week.
I know.
Yeah.
I think Tyro is at the very end of being taken out by corporate players, isn't it? I think share price actually performed quite well for shareholders.
If you bought low, it's rebounded nicely.
Right. It's just be incredible. I think eventually this company won't be listed for very long. It'll get taken out. It just works better as part of a bigger group. We always talk to the market condition for those companies change. Same as buy now pay later. You need a big group to support you because the technology is good, market positioning is good, but you need capital to grow, to expand.
Yeah. What about EML? It's been a really interesting company. New CEO, had problems with the Bank of Ireland. Have you run your eye over EML? Yeah,
we looked at it over the last little while, but with the regulatory risk, I think it's just making it a bit too hard basket.
It's like too many problems.
I think so. If it was just one territory, it's okay. Now you got UK inquiry, that will just drag on for a long time. Hard for people to dip their toe in. It's very, very cheap, and I know it's got a lot of cash on the balance sheet, and that balance that gets high interest rate spread. So like a bank, they make more money when the interest rate goes higher. But the challenge is just short-term business model. It's very hard for even corporate player or investors to get a comfort of.
Okay, well, what about a company like JBHiFi? We know consumer discretionary might have a tough time this year, but is it in the buy zone for somebody who wants to hold it for 2 or 3 years?
Yeah, look, if you buy JB today, you can hold, and then the share price probably won't lose its value. I just had some feedback that the Black Friday that just gone, JB's category is a little bit weaker. But clearly
that could be a good sign for the economy in terms of getting inflation to come down.
Exactly. So but look, I just for those retailers, it's not expensive. It's on 12 times. If you hold it through the cycle over the next few years, it will be share price will be pretty defensive. You get a good dividend, but just meantime, the next 12-month earning will probably come down.
Now I'm going to ask this question because we recently had someone come in my financial planning business. Who was given a tip on a company called Pilbara Resources, and they decided to put all their super, 500,000
into it.
Yeah, and they now have $10 million.
Wow.
So they want to know whether they should stick with lithium. Is lithium?
I would tell him to take profit.
Yeah,
I would tell him
that's exactly what I said.
Look, long-term thesis, lithium is great, right? Yeah. But for the short term, we've seen how much lithium price has gone up by this year. And
they're staggered. It's a big bet for them.
It's a big bet. Yeah. It's a lot of risk. Look, for me, it's my portfolio. I always have a little bit of portfolio in those spicy things. High risk things where if they do really well, you'll get a bit of payoff. But it's not big part because it's so volatile, and it's all based on China. And at the moment, lithium price is going through a bit of wobble at the moment. China EV sales is down quite a bit, and as you know, China, this reopening and everything, there will be start-stop. So that will be a bit more negative news coming through, and long-term thesis fine, but short-term I think it's run to
their problem because they take profit is big capital gains tax as well.
Oh, okay. Well, yeah, it's still worth it because you never look at crypto. It can be very volatile.
Yeah.
So yeah.
And there are those people who say that there is a lot of lithium out there, but it just hasn't been mined.
See, that's the thing. When you look at the commodities, that's normally how the cycle works. Share price spike because there's demand and there's not enough of them, and they're selling all the miners throwing money at it. And the lithium is a space where the price is multiple times of the reserve, right? So it's way too expensive at the moment.
Okay, so while I've got you here, I get this question all the time. I've made a lot of money out of Whitehaven. Do I take the profit?
Yeah, I'll be taking profit in coal. Yeah, I think it's done very well. But the short term, you still think, how is that going to change? Given there's still tension with the oil prices and coal, you can only get Russia, all these issues, right? But my view is that ultimately these companies don't have a terminal value. It's going to be really tough. So your time is now, between now and next 6 months. So any time between now and next 6 months, you just never know when the sentiment might change.
Yep.
Yeah.
What was the last company you added to your fund? And why?
Look, I think more recently what I've been buying more, Woolworth.
Yeah.
I think when we spoke about Woolworth, it was just on its knees, had an update,
so
was
nice
terrible.
Low price at the moment.
Yeah, we actually went overweight. We were underweight. Now we went overweight. We're actually aggressively buying some. I think Christmas will be good for them.
Yeah.
This will be the first Christmas in 3 years that people will celebrate together.
Yeah.
People will go to restaurants and people will spend buy lobsters at home.
Big turkeys.
Exactly, people will do so. I think Christmas is going to be good. Companies still generate very good margin. It's very defensive, especially heading to Christmas. You should have things like that in your portfolio. It's defensive, it's staple, and earnings still going to be good.
Okay. That's Jun Bei Liu with a Christmas gift by Woolworths. A few weeks ago we talked about how a good inflation number would eventually show up in the US and the market would like it. That's what happened.
Yeah, that's certainly what happened a couple of weeks ago now. We had that enormous intraday rally in the US, and then it's been followed on the last couple of weeks. I think it does increase the chances of a decent run up into Christmas, but obviously you've got the inflation number for this month coming out in a couple of weeks' time, so you can't count your chickens too soon, but I do think the chances of that worst case scenario playing out seem to be diminishing somewhat.
Yeah, it seems to me if the December 13 number is a really, really good one, there'll be I've described it as the mother of all Santa Claus rallies. They'll love it, won't they?
It's definitely possible. And I think the markets are feeling a little bit more optimistic, but a lot of the institutional investors and professional investors still remain cautious.
Yeah.
And I think you still have to, because by no means are we out of the woods entirely, but I think the outlook is somewhat improved compared to what we were looking at a few months back.
Yeah. It seems to me also that if the inflation number is not quite as good and the market sells off, to me it's a buying opportunity if you're a person who is prepared to wait a year for some really nice returns.
Yeah, absolutely. On a long-term basis, after falls of this magnitude, particularly in the US, looking out 1, 3, 5, 10 years, normally the returns are quite good. So I think if you're a long-term patient investor and if you can wear the short-term volatility, I think the opportunities are there.
The important question for a lot of people watching this is, well, tech has been slow really to rebound. On some days when good news came through, we've seen pretty substantial bounces, but it hasn't been sustained, and there is a narrative out there saying, oh, well, big tech might not rebound for some time. Where do you sit in that story?
Yeah, look, we probably think the tech space as a whole, it was very, very expensive. So if you look at the ASX, the top quartile most expensive stocks at one point were trading on PEs of about 60 times earnings. The top quartiles now dropped to about 35 times earnings, but it's still expensive relative to the long-term history. So I think the tech space overall, you can't just look at it as a whole. I think it's going to be very fragmented. You have to understand there are very high quality tech businesses that have been around for a long period of time and been through the cycles. They're growing revenues, growing earnings, but then you've got another whole cohort of tech businesses that in some cases don't even have any earnings, or they might have strong revenue growth, but have never delivered a profit. Cash flow's still not expected to turn positive for a couple of years.
So they're being hit by rising interest rates.
They're being hit by rising interest rates. So I think that inferior quality tech space will probably lag and will take some time to recover. I do think the valuations that we became used to over the last 3 to 5 years are unlikely to be replicated, but I do think there is some value in some quality tech names.
Well, some of these companies, even if they recover half all of their losses,
that's it.
Like Atlassian was down like 70%.
Yeah.
I wouldn't be surprised to see a 30% rebound at Atlassian in a year's time or so.
Yeah, definitely.
Okay, let's talk about some of the Aussie ones before we talk about some other unusual ones I was asked about in our Boom Doom Zoom show for Switzer Report subscribers. And these are two that you've always liked. Ordinate,
Yes.
AD8. It's done well as a tech company, hasn't it? You're still backing it?
Yeah, absolutely. The narrative hasn't changed. If anything, it's improved. They continue to win market share. The adoption rates relative to their nearest competitors are up from 5 times the adoption rate of the nearest competitor up to 14 times. They're diversifying the business model away from relying purely on audio digital into video digital space, and that's expected to add to revenue substantially for the next 8 years or so, up to 2030. They're also increasingly moving away from hardware sales to software sales as well. So those two are two components that generate their earnings, and the software sales has very high margins of about 90-95%. The hardware sales still has very good margins of 70%, but over time that product mix is favourably shifting for them. So it's a very high quality business. They continue to have some issues with supply chains, but a lot of those issues are alleviating over time. But it's always a good problem to have when demand is significantly stronger than what you're able to meet the market at.
Yeah, so obviously China's COVID problems isn't great for supply. I was just wondering, because China has a whole lot of big events and Ordinate suppliers. I wonder if they're missing out on business in China.
Well, it's definitely a case. That hopefully is one area that can still recover for them.
Yeah.
They've obviously seen the COVID bounce back in the developed and Western world, and we're seeing a lot more events and a lot more outdoor events. So,
but Chinese events are seriously big events.
So look, that's a sleeper for them. But even without that recovery, they're still in a very good position, and they continue to grow nicely.
Okay, MP1, Megaport. Yep.
It's a bit more complicated at the moment. It's quite difficult to get a read on where Megaport's going, because from one quarter to the next, their numbers are jumping around a fair bit. We saw in the annual report they came back a long way. There was a disappointment in new customer acquisitions. That improved in the September quarter and then fell away again recently in the most recent update. So Look, we still like the business from a long-term standpoint. Nothing's probably changed on that front, although we want to monitor the customer acquisition growth going forward, because a lot of the analysts, and we probably are on the same side as that, have pushed out their free cash flow positivity from late FY23 to FY24, but they are looking to have their first year of positive EBITDA. So it's a business that has made the transition from a sort of startup tech name into making the transition to a profitable business.
Yeah, and it seems to me, it suffers because it's a tech company.
Yes.
And if tech companies are suffering in America, they'll suffer here. So one part of their lack of price rise is that. The other part is the actual story of the company itself.
And that's why it's been pretty volatile, up to about $10, down to $6, back up a bit now. But I think it's another good quality business with a lot of good quality clients. They've got strong pricing power. They offer a product that not many can compete with. It allows businesses to basically come onto their network when they require a lot of data and then come off it when they don't need it, and they're able to price or pay a price for when they need it, when they don't. No long-term contracts in that sense.
What's your favourite stock right now for your clients?
Right now, we've been buying things like IDP Education. We think that's again, this isn't a very cheap company, but they're very much on the recovery path from COVID. Basically, IDP Education's got two parts of their business. It's got the student placements. So a lot of students coming from places like India getting placed into Australian or UK or Canadian universities. Then they've also got the English language testing, which is another growth part of their business. But they've recovered significantly, and they've now delivered student placement numbers and revenue numbers exceeding their pre-COVID levels after a big dip due to COVID. But that's a company we like a lot. Another one is Auckland International Airports. We quite like that still as a recovery story on the COVID play. The capacity or the number of people flying out of New Zealand has increased significantly, more than expected, more than forecast. And there's still a big recovery path to go. They're only still at 70% pre-COVID capacity.
Yeah, I went to Auckland recently and was surprised how good the city was, and I think a lot of Australians would be surprised.
Yeah,
you can do a lot in Auckland. That Waiheke Island as well, it just offers fantastic.
Well, they've got a good diversified business model, and after all the acquisitions that have occurred on the ASX of high quality infrastructure, this is one that remains. They also own a big chunk of the Queenstown airport as well. They also own a lot of the land around their airports. It's a very popular area. Yeah. And they've obviously got a lot of retail that operates within these airports. So we still like that as more of a conservative quality infrastructure play, and we expect dividends to eventually kick back in as well.
Okay, so they were a reasonable dividend player?
They were previously around 3.5%. They had to obviously cease the dividends during COVID.
Is that US dollars or,
that's
New Zealand dollars or Aussie dollars?
Well, it's a percentage, so I think it was New Zealand dollars, but it was a percentage of the overall share price. We like that. And another final one for a smaller cap is XRF Scientific, which I think we've discussed previously.
XRF
Scientific.
That's a highfalutin name, isn't it?
It sounds sexy, I suppose. It's involved in the mining space primarily. It provides testing kits to miners who can test their core samples and get a bit of an idea of the quality. But what's been good about XRF, they've sold a lot of their machines in recent years. But they also now sell the consumables, so the different types of chemicals required to conduct the tests. So once someone has the machine, they then have to keep replacing the chemical side of things to keep using it, and that gives them a good recurring revenue stream. But that's a bit of a smaller business, but still it's not a specky, it's quite mature and got a good balance sheet, pays a good dividend.
Okay. These two companies were asked about at last week's Boon Doom Zoom show on Thursdays for subscribers. Weebit Nano, I didn't know much about it, but did you know much about it?
I've heard about Weebit Nano. It often gets bundled together with brain chip. It's basically circuit boards and memory chips.
See, Altium was in that space once.
Yeah, well, they're more the software used to design the circuit boards. These guys are actually providing the still semiconductors. It's a competitive space. A lot of the big players like your Googles, your Microsofts are involved in it, so it does put them in a little bit disadvantage competing with those behemoths. Weebit Nano doesn't have any revenue. It's never had any revenue. Trades on about 11 times book value, which is actually cheaper than BrainChip, which trades on about 20 times book value.
So is it perceived as a potential takeover target?
Oh, look, possibly. Like they're they've met all the different hurdles that they need to meet in terms of the quality of their product. It's just now about going out and marketing it. They do have a fair bit of cash on their balance sheet, probably to get them through the next 1.5 to 2 years. But with these companies, it's difficult to get overly excited about them given the falls that we've seen elsewhere in the market, because Weebit and BrainChip are very expensive by anyone's measure. But they've actually held up remarkably well considering the carnage that's unfolded in the broader tech space. But I think it's one for the true believers, really. You have to really have a long-term and confident view.
Yeah, and I always find the problem with small companies that, you know, the market doesn't necessarily pick up on the really good news. They can ignore it, can't they?
Well, these have got a big following, I think, in sort of retail land, maybe even the hot coppers of this world. There's a lot of discussion about some of these emerging tech names, and the story sounds great. Like they're more efficient chips, you know, they're easier to produce, they're more cost effective for people to use, but again, it's a highly competitive space and you're going to need a lot of cash to commercialise that in time. Okay,
final one is United Malt Group.
Yes, so this was spun out from GrainCorp a few years ago. They've benefited a lot from the boutique brewing industry, and there's a lot of demand for barley globally. And there's a lot more barley that's required in the production of boutique beers than your more traditional drafts.
And do they use barley for gin? Because gin's really going through the roof.
That's been going through the roof. I don't know how much barley is required relative to obviously your
beer.
You're
not a drink scientist, are you?
No, I'm not. Very much not. But the problem with United Malt Group is they have a presence mainly in Canada, believe it or not, and also a little bit in Australia. There's been drought in Canada. Their production numbers have been down 20-30%. I think down 20% on the 5-year average. And because they've got all these long-term contracts that they need to meet supply on, if they're not producing enough from the properties they own, they've actually got to go into the barley market and buy it to make up that shortfall. But on one hand, it is good to have those contracts locked in. Those contracts are flexible on price, so it works well when the barley price is going up. They're able to pass on those costs through, but also works on the other direction as well. If the barley price is down, they take a bit of a hit there. There's a lot of been very high freight costs, very high transport costs. They've started to come down a little bit, but their earnings aren't expected to really recover to where they were for about another 3 or 4 years. But look, typically we tend to steer clear of these cyclical commodity type agriculture businesses. So many curveballs, and it's really no pricing power. They have no control over barley price, and there's a lot of competitors as well. It's a pretty ubiquitous product in the end of the day.
I instantly think about a company that was a terrific company, Costa Group, but there's so many curveballs that company has faced, internal and external. It's just too hard.
So it looks cheap, but that's because it's just so difficult to predict with any certainty the long-term earnings profile.
Michael, thanks for joining us.
No problem. Thanks, Peter.
That's Michael Wayne of Medallion Financial. Well, with US inflation heading in the right direction, Paul Rickard has looked at 3 stocks he thinks look really well placed for 2023. Paul, is this inflation coming down the reason why you think these stocks will make a rebound in 2023?
Yeah, I think so, Peter, because they're all in the sort of growth category, and clearly what we've seen the last sort of 6 to 9 months is the market's punished growth stocks with interest rates going up. So I think to sort of go back to the situation where it's going to put value on growth stocks and go back, I'm not saying it's going to change its valuation multiples, but at least be prepared to get away from sort of more the defensive end of the market. It needs to have a view that inflation has peaked, and therefore interest rates, the next big move in interest rates is down. That doesn't mean it has to happen. The next interest rates have to come down. Just the market's got to come to the view that they're not going up any further.
And you're a watch of the bond market. The bond market's basically saying they believe the worst of this interest rate rises is over.
Yeah, the bond market, big rally in the US. I mean, we got to about 4.3% on the 10-year. We're now down to about 3.7%. So that's a big movement in 10-year bond yields. So the bond market certainly thinks that, look, they're not going up as quickly as they are, and maybe they've peaked. I still think the markets, between now and December the 13th, I think it is, when we've got the November CPI in the US, that's a really big number because that will be either confirmation or not.
Yeah.
And I think the market wants to see a couple of months because the monthly statistics, there's a lot of volatility in that sort of stuff. So it wants to see confirmation that inflation is heading down, and that will allow the market to take a view that the US Fed's going to, I'm not saying we won't be more increases, but it's at least we're coming towards the end of the interest rate increasing cycle, and 6 to 9 to 12 months after that, interest rates will start to tend down.
Okay, so let's go to your first one.
Yeah, look, probably no surprises, Pete. CSL, you know I'm a huge CSL
me
fan.
too.
It's really interesting because it's now back up to almost $300, and if you look at it this year, it's tried to break the $300 level about 4 times.
Yep.
Still hasn't done it. It's been a lot higher, obviously, at the early part of COVID, but for a stock, it's actually up year to date, which is a bit surprising, might surprise a number of people, but it's not a stock that people yet want to power into, despite its sort of performance as being the leading healthcare stock. So every time it's got to $300, it's worked away from it, but I think we're going to see that breakthrough at some stage through $300.
Yeah, and the new part of the business they've added from that Swiss, related to kidneys, isn't it?
Yeah, the treatment of chronic kidney disease and other renal things. So it's now called CSL V4. It was V4 Pharma. That's going to be an important part to the CSL armoury over the medium term. Not a huge contribution to profit this year, about $300 million US. But look, the CSL had the same when it acquired Seqirus, which was the influenza vaccines business. That took a few years to really work really well for CSL. So this is a company they looked at for a decade. So they've obviously wanted to buy it. Give them a chance. This is in an area where lots of really good demographics in the sense of demand. Chronic kidney disease is actually hugely on the up.
Particularly with the drinking that's on the up as well.
Yes, so they've purchased for all the reasons that should provide a lot of long-term tailwinds to support the business.
Okay, let's go to your next one.
Yeah, so again, the next one is Macquarie Group. Now, Macquarie's really sort of come down a bit in the last few months. And I guess this is a function of the market being a little bit concerned about Macquarie's exposure to corporate markets and corporate activity. And as interest rates go up, often we see that the business cycle slows down a bit and investors get a bit nervous. And we've seen the slowdown in private equity and fewer IPOs. And so Macquarie slows for that reason. It becomes harder to sell assets because there's just not as much interest. And then even on the commodities business, which Macquarie is doing really well out of, that's coming off a boom, and maybe there's some slowing activity as prices come back a little bit. So I think the market's just sort of said with Macquarie, look, we're worried about, might be a little bit tougher globally the next 12 to 24 months, and therefore some of its corporate activities will slow down. That's why the prices come back. But look, I think you put that to one side, you back a winner. It's in the top 2 or 3 Australian companies. It's 60% plus of its revenues now offshore. Has a mix of both what it calls market-facing and non-market-facing businesses. And a bit like CSL, Pete, the other reason I like Macquarie is it has a history of positive surprises. Like it under-promises, goes cautious, gets conservative in its outlook statements, and then likes to over-deliver, the same way CSL does. Yeah. And it has a history of surprising the market, inverted commas, when it delivers, and the market sold it off. So I think there's value in Macquarie as a long-term play.
Yeah, I link Macquarie to the strength of the US stock market, and it's been down, so therefore Macquarie's down. But I think when the US stock market roars back sometime this year, I think Macquarie will be a beneficiary. Let's go to your third one.
Yeah, and the final is Xero, which of course is the cloud accounting software business. Phenomenally successful in Australasia. That is a Kiwi company, I think they claim credit for. So, but its biggest market.
Without us, they wouldn't have got there. But go on.
Its biggest market's Australia. But where Xero, of course, is heading is it wants to see its next leg for growth is in the US and the UK, and that's struggled a little bit. Not that it's not growing, but it's not growing at the rate the market wants it to grow at. Xero, of course, in a sort of a software as a service company, has been subject to all the global de-rating of those sort of companies. So it's off about 50% in 2022. Just like most other high growth tech companies are also down by that sort of magnitude. And now, although it's been phenomenally successful in Australasia, it now needs to demonstrate that it can do the same in the US and UK markets.
Yeah.
I'm a believer it will because for a couple of reasons. We know their software is pretty good.
Yeah.
It's very sticky. People love it.
We use it here.
We use it. I use it at home. It's got a really high customer rating. They've been able to increase revenue, average revenue per user. Surprisingly, the market in terms of the provision of small business software in the UK and the US is actually sort of behind Australia. So despite some global giants in that marketplace, there's big opportunity. So massively bigger market and also a lot of opportunity for better software, better cloud-based software. So I think it's going to get there, but again, you got to back it, and you back, I think, something that again that's been pretty successful and has been able to show that it's demonstrated some great metrics in terms of the so-called SaaS metrics.
Yeah, it seems to me that they try to make big headway in the UK. Of course, they've got recession challenges over there. And I also think it's a tech company, and as you implied, tech companies have been beaten up, so there'll be a natural uplift when tech companies are eventually forgiven and people buy it again. And Paul, you got another roughie, but you're going to keep that for the Switzer.
I'll keep the roughie of the Switzer report. So just go back to those three, and there's roughly a reason I'm just hesitating, Peter. It is a micro cap, so got to be a little bit careful. But you'll see that on the Switzer report. But look, the premise for all those three things is interest rates. I'm backing the market view that they've probably peaked. The next big move, and it might be 12, 24 months away, is down. Obviously, if we get to the situation, where we don't get confirmation around inflation, and look, Australia's going to follow here the US anyhow. So, and the market starts to think that this is, the next big move is not down. It's having to be up. Those companies, because they're all sort of in the growth category, will do it a bit tougher.
And I like the idea, Paul. All three of those conform to what Warren Buffett would say. When the market wants to beat up on quality companies, it's a good time to buy them. That's Paul Rickard of the Switzer Report. Go to switzerreport.com.au. And that's the show for tonight. Thanks for joining us. Don't forget, we're back on Thursday. If you want to know more about some interesting stocks that haven't been presented in this program, go to switzerreport.com.au. Thanks for joining me. See you on Thursday.